Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in, take a look, see what is going on today. Just as a reminder, we do have a question and answer session today at 5 p.m. Mountain Time. If you want to follow me, it's at Fair Finance, and if you want to join our community, findingvalue.com. That's where we have that 5 p.m. Q&A session later today, and I'll go over the questions, whatever you guys want. I am going to go over a couple of companies, some of their earnings calls, as a prerequisite, as some people wanted me to cover that. Special is the coupon code, and it is still active. So Seth Golden, he says, after 1987 crash, Peter Lynch was interviewed about minimal hedging for the Magellan Fund. This is what he, quote, said: perpetually planning for downside in constructs that perpetually move higher is a puzzle to me also. Lynch accepted drawdowns for greater returns. The Magellan drawdowns, as you can see them, over time. Now, keep in mind, this was also during a declining interest rate environment. So Peter Lynch had massive tailwinds behind him during his entire time running this fund in stocks. Stocks were the place to be from 1982 and onward. 1982 was right in this drawdown here, the minus 56%, and it was all tailwinds from there on out. This whole right half is all tailwinds. Now, before that, in the early 1970s, there was obviously some rough periods. There was other very large drawdowns, but this is Peter Lynch, one of the best investors in the world. Look at the drawdowns that he had to experience throughout his time. And that's the cycle. The real estate cycle brought him down 56% here. We had another big move, another 27.5% move lower in the 1984 83, 84 area. Another very large pullback in 1987, down 42%. Nice little shoulder head, shoulder bottoming pattern there. Then worked its way on back up. And then another 32% down period. In 1990, 91, that was a real estate slowdown. So this was a real estate slowdown here and here. And I can't remember if there was one here and how big it was. These all might be real estate slowdowns for the most part. But that's how he outperformed. The way that he outperformed was to get larger asymmetric companies than the S&P 500. But he also had to endure larger pullbacks. That is what I think is the correct view to use. It's to go long, stay long, and live with the volatility. Now, some people, they can't live with the volatility. They don't want to get rich. The only way you can get, quote, rich we'll say a reduced time frame is to live with volatility. Everyone thinks that it's just going to be a ride higher with no big pullbacks. I don't know anyone who can do that. I just don't know. I go back in history. I'm looking for people. I think there's a few, but I also think that they gave some room to the upside. Something like a Stanley Druckenmiller. But just because you have an up year every single year doesn't mean that your returns are the best, because he didn't have the best returns over the long period of time versus some other people. I mean, his are damn good, don't get me wrong, but he wasn't the best. There were people who had 10-year periods where they just blew everyone out of the water. Very high returns. Much, much better than 20-something or 30-something% returns. They were double that. But the big question is, you'll always have people that are like that no matter what you do. And it doesn't even mean that their strategy was that great. If you've got hundreds of thousands of people or millions of people that are investing in the stock market, someone will always have the highest return in a year, irrespective of their strategy, irrespective of anything. It's just the right place at the right time, and there's so many people that someone has chosen the right path. Even over a 5 to 10 year period, you could run that or milk that, so to speak, with sheer luck, where you make a few good decisions and they end up returning the most of everyone. And if you've got millions of people doing it, they're all making these decisions and changing perhaps the equities that they own or different asset classes. Someone or some group of people may do incredibly well, irrespective of their strategy. Their strategy may have been subject to just being lucky because there's so many people. It's just like all of the richest people in the world today are mainly tech people. And tech went through the largest boom uh, that we've seen in, I think, history in terms of its overvaluation. So is it of no wonder that all the richest people are in tech because we have the largest tech boom? And that kind of makes sense. They were in the right location at the right time in the right sectors to have money flow into it with a declining interest rate environment for 40 years. And it all went into tech. And that's where your richest people came about. Now, did those people on purpose go into tech because they thought they were in the right market condition? No, I don't think so. They just benefited from the tailwinds. And then everybody looks at them like, oh, these guys are the smartest guys ever. It's like, well, in other times in history, there were other things that did incredibly well that were not technology based. Would you have said the same thing in 2000, 2001, 2002, 2003, 4, 5, 6? No, I don't think tech did all that well. And things shift and change as the markets have different market conditions. But this is Peter Lynch, and this is his drawdowns. In commodities, if you're in the commodity space, you're going to get more larger drawdowns more frequently, unfortunately, and they're very hard for people to hold on. And I don't blame them. It is hard to hold on for sure. Eric Yoon says, "Ew, I stepped in crap. Milkshake simps." Eric is going after the milkshake guys, basically saying they're full of it. That's which I agree. I think they are full of it. Technical analyst and a fundamental analyst are chatting about the markets in the kitchen. Accidentally, one of them knocks a kitchen knife off the table, and it lands right on the fundamental analyst's foot. The fundamental analyst yells at the technician, "Why didn't you catch the knife?" He says, "Technicians don't catch falling knives," the technician responds. And then he asks the fundamentalist, "Why didn't you move your foot out of the way?" He said, "I didn't think it could go that low." Nice little joke going on there. Unusual Whales, Powell, if the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. I think he's just offloading it to Trump because he put the tariffs in there. I think irrespective that we're going to get inflation here. M2 money supply is going up. That's where inflation is originated from. You don't get inflation from tariffs. You could get unemployment as the economy shifts from perhaps if the tariff percentages are large enough, the economy needs to shift to produce more things, maybe perhaps somewhere else. Maybe they'll permanently just be higher costs, and maybe we see larger unemployment in certain sectors for America and they need to shift into a different sector or something like that. Difficult to say, but yeah, I think he's just putting it on Trump now, and I'm not pro or anti any side of government or anything like that. But all I'll say is more taxes are bad. That's all I'm going to say. More taxes are bad. And Powell's just trying to offload. Fact is, nuclear is one of the safest energy sources. I think it is the safest energy source. We compare it to say, solar and wind, and they say that the safety of solar and wind are incredibly high. I completely disagree with it, though. You also have to take into account people installing these things, falling off of roofs, the damage to the environment that solar and wind do. Depending on what solar you put in, birds actually catch on fire. They get torched depending on the solar that you're using. Wind also destroys animals, birds and stuff like that, getting hit out of the sky. So yeah, it depends how you look at it. I would say nuclear is probably the safest of everything by a long shot, both the environment for animals and for humans. Peter Schiff says Trump warned Walmart not to increase prices because his tariffs increased the cost of their imports. Trump said Walmart should eat the tariffs. He might as well tell Walmart to eat its rent, wages, insurance, utilities, and all of its other costs too. Ironically, if the goal of tariffs is to reduce our trade deficit, the only way that will happen is if Walmart and other importers raise their prices. It's higher prices that will cause consumers to buy fewer imports, thus reducing the size of our trade deficits. Yeah, this doesn't make any sense to me, guys. Don't raise the prices, but that's the very thing that you want to happen, right? You want to raise the price so people don't buy Chinese products and then you buy American made products. Isn't that the whole thing that we're trying to do here? I am confused by what this is saying. He is saying that Walmart should eat it. And it's like, why? It's a private company. Why should they eat this? I mean, wouldn't we say back, why don't you reduce government, the size of government? Why don't you just like literally cut it up? How about we reduce it to maybe like 10% or 20% of what it currently is? I mean, hog wild cutting. Uh, why don't we do that? Why are you telling people who create value, which government creates no value? Why are we having no value creation people tell value creation people what they should do or shouldn't do? That doesn't make any sense to me. Gold versus US equities. Gold is 40% of US equity market cap, long term median 38%. 1970s wartime peaks up to 160. 2011 peak is 69.2%. We're far from past gold bull market extremes. So this is gold market cap to US equity market cap from 1925 to 2025. And it just goes from overvalued to undervalued for gold. Overvalued gold, undervalued gold. And we haven't gotten all the way back up to a high overvalued location against equities. So it's still good, and we're starting to work our way on up. Looks like we've got a nice little double bottom that occurred, and we've broken the top of that double bottom, that bottoming pattern. Gold is on its own trip. Gold's remarkable rally outshining a slumping commodity market is what we've got here. That occurs sometimes. You could see the disconnect here where gold went up and the equities and energy in total went down. Um, and that was front running money printing. I think that's what this is doing too. I think it's front running money printing, and we are seeing a lag behind this with gold moving higher. Now, is it a potential case where we get stagflation, but the market gets it wrong? So they bid down energy, they bid down food and other stuff. Gold starts ripping because inflation and a slowdown, that's the stagflation portion. But if it's inflationary, I do think that the other stuff will follow with time. It's just going to take a little bit of time. QQQ, and now we wait for a resolution, NFA. So we're kind of at the bottom end of this rising channel where it could potentially roll over. You could still make a bearish case here because we are underneath the channel there. If we get back into the channel, maybe it's no harm, no foul. I don't know. But we're not up there yet. So Now it's for QQQ. You get paid for being right first and to be first. You can't wait for consensus. That's actually pretty common. You got to get there first, and that's the difficult part. Some people say, well, being there early is wrong, but yet you're trying to get there first. So it is being early getting there first, or is it like the exact moment that something inflects and turns positive, which is impossible to catch the bottom? So what is acceptable for an early entry point versus being first? And that's what's difficult. You hear all these quotes and it's like, well, what exactly does that mean? You get paid for being right first and to be first. You can't wait for consensus. Well, waiting for consensus means that everybody agrees with you and everybody's already positioned in that particular thought. So you have to be there before that. 12 U.S. oil companies slashed 2025 capex by $1.2 billion. You think this is what's going to increase oil price? Do you think this looks like drill, baby, drill? This looks like decline, baby, decline. And what about all the people that get employed in the oil sector? If we've got someone trying to set prices at $50 or $60 a barrel oil, and they keep coming out saying, look at oil price, look at oil price. They do understand that they're destroying jobs, right? So they're destroying jobs in the energy space. They're destroying jobs in the trucking space and shipping space. They're starting to destroy jobs all over the place. Is this done on purpose? And what is that purpose? Why don't we destroy government jobs, like a monster amount of them, and then convert them to actually producing goods and services that people want and that are willing to pay for? Otherwise, you're just growing this gigantic leech on the back of an economy where they don't generate goods and services for people. They just go into government and then leech off of everyone else. We need to get rid of that. And I mean, we need to get rid of it massively. They're too much of a percent of GDP to sustain, in my opinion. This is blowout sentiment extreme on the public inflation expectations, now at 7.3%. This comes even though year-over-year CPI went from 3% in January to 2.8% in February, then 2.4 in March and 2.3 in April, a four-year low. I think the public will get this wrong, and this is the public is often wrong on inflation. Look what's being projected over here on the Michigan Sentiment Survey on the one-year inflation expectations, up 7.3%. That's what people are expecting. And here is the fake US CPI year over year at 2.3. Now, this is probably going to follow upward. How much? I don't know. They manipulate that number to the max. But here we are with sentiment saying, you know what? I think we're going to get something bad coming here. And you know what Powell's doing? He's positioning himself to blame someone else. That's all from M2 money supply. He's saying, oh, it's going to come from the tariffs. No, they're printing money, guys. I even think they're doing stealth QE. I think they're in there buying bonds, trying to hold the interest rate down below 4.5%. And that came from Besant's mouth, not mine. Besant said that. Powell's back there probably doing it off of a balance sheet that is hidden, absolutely hidden. And this is what I think is going to transpire is inflation, because that's very inflationary if you do that. Relative to incomes, housing costs in this country were in decline for 39 years. From 1981 to 2020, monthly mortgage payments on a median-priced house rose a merely 34% over 39 years. That's cost inflation of 0.7% annually, well below the rate of inflation over that duration. And this is in response to, people don't really talk enough about the Polish YIMBY success story, talking about it coming down. He's saying, well, yeah, we also declined in America because of declining interest rates, the affordability aspect of it. So then he says home prices appreciate despite stagnation in housing costs because mortgage rates fell from 17% to 3% over that period. In 1981, annual mortgage payments on a median-priced house consumed 55% of the median family income. In 2020, it consumed less than 20%. Nobody talks about that. Well, we are. We're talking about that. So a big chunk of affordability comes from the mortgage rate. Mortgage rates since 1981 declined the entire time, and just recently mortgage rates have gone up. The stock market signal has only occurred 3 times in the last 47 years. Market studies, historical performance, and charts. So this just happened. What is he talking about? This is increasing from down upward, and it just occurred, I guess, recently, where we've marked major lows in pullbacks in the S&P 500. So he's calling potentially for a move higher. And this is it right here. He's talking about the absolute extreme to the downside that we have achieved in 2025 for the looks like a relative strength indicator or momentum indicator. So 1, 2, and 3 have come this low. Historically, we've gone up from these levels, and they've marked bottoms. Bottoms in sentiment. In the weekly COT report, the small non-reportable traders of crude oil futures are almost always net long as a group to varying degrees. When they get up to a big net long position, that is a good marker of a top for oil prices. The last time they were actually net short was in 2019. They got close to the 2020 COVID low. When they go short as a group, it does not usually work out well for them. President Trump is talking about getting oil prices down even more, but these data cast doubt on whether that is likely to actually happen. And everyone down here is pretty net short, not net long. So net long is up, net short is low, and we're towards the lower end of net short. So this generally is where we mark bottoms, not tops in oil price. So this is Scotty Bissett. He says, Scotty needs 7% nominal growth to simply tread water. Right now, he's drowning. And he's talking about the 7% fiscal deficit that we are spending. We need 7% nominal growth to stay even. U.S. Treasury Secretary Bissett, I believe the net or the debt to GDP ratio will drop next year. No. Here's my favorite chart so far from Ronnie Stoperle, and I just went over that one up above with a different color. So we'll keep going. My simplified gold roadmap towards $4,000. We're at this resistance area that we've been kind of tracking sideways. I'm sure we'll break it with time and then work our way on up with gold. He says a roadmap to $4,000 gold prices is what he's seeing. CEO of Permian driller Ring Energy said in an interview, prices should be around $85 a barrel to encourage companies to drill. Oil prices have fallen to 62-ish dollars. That price is roughly equivalent to about $45 in 2015 dollars. Sideways and the decline in rock quality. And it's people, the companies are just coming out and saying, you know what, we're going to cut CapEx. We're not drilling at this price. So drill, baby, drill, as much as it's a slogan, there is absolutely nothing to it. And I kind of find it a little bit appalling if we're one of the largest drilling, one of the largest oil producers in the world, and our president doesn't understand that $50 a barrel oil will destroy the industry. That's pretty ridiculous. And to come out with a slogan saying that, and to run on it and have the exact opposite as the outcome is a little bit concerning for me. It's a little bit concerning. And this is U.S. drillers say peak shale has arrived. Lower oil prices are expected to precipitate a decrease in crude oil output that won't easily be reversed. Well, let's set up a $250, $300 a barrel oil run. Let's do it. Let's hold prices down at $50, $60 a barrel. That'll set us up for multi-$100. If we see a decline in oil at the same time that demand goes up, we're going to eat through inventory, not be able to respond that quickly because Our drilled uncompleted wells are depleted. Our inventories of them, our inventory of everything. We've pulled back on rigs. We've pulled back on stuff, and a lot of the times when you bring those rigs back online, they need to get them serviced and bring them back in the field. So it's not, you don't just bring it up and go. It takes a little bit of time to bring everything back up to speed. So this is setting the stage for a big oil bull market, in my opinion. U.S. household now. Okay, I already went over that last time. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We've got a question and answer session coming up at 5 p.m. today, Mountain Time. All right, guys. We'll catch you next time. See you later.